Hello student, I teach you financial management in very easy way. We are our Infoline organization designed simple notes for you. Please subscribe, share, like our Aary Infoline organization channel on www.youtube.com. Unit 1 Financial Management, Introduction, Meaning, Objectives, Scope of Financial Management, Finance Functions, Structure of Finance Department, Emerging Role of the Finance Manager, Profit Maximization to Wealth Maximization Approach. Meaning of Financial Management. Financial management means planning, organizing, directing and controlling the financial activities such as procurement and utilization of funds of the enterprise. It means applying general management principles to financial resources of the enterprise. Scope, elements. Investment decisions includes investment in fixed assets, called as capital budgeting. Investment in current assets is also a part of investment decisions called as working capital decisions. Financial decisions, they relate to the raising of finance from various resources which will depend upon decision on type of source, period of financing, cost of financing and the returns thereby. Dividend decision, the finance manager has to take decision with regards to the net profit distribution. Net profits are generally divided into two. Dividend for shareholders, dividend and the rate of it has to be decided. Retained profits, amount of retained profits has to be finalized, which will depend upon expansion and diversification plans of the enterprise. Objectives of financial management. The financial management is generally concerned with procurement, allocation and control of financial resources of a concern. The objectives can be: Num. 1. To ensure regular and adequate supply of funds to the concern. Num. 2. To ensure adequate returns to the shareholders, which will depend upon the earning capacity, market price of the share, expectations of the shareholders. Num. 3. To ensure optimum funds utilization. Once the funds are procured, they should be utilized in maximum possible way at least cost. Num. 4. To ensure safety on investment, that is, funds should be invested in safe ventures so that adequate rate of return can be achieved. Num. 5. To plan a sound capital structure, there should be sound and fair composition of capital so that a balance is maintained between debt and equity capital. Functions of financial management. 1. Estimation of capital requirements. A finance manager has to make estimation with regards to capital requirements of the company. This will depend upon expected costs and profits and future programs and policies of a concern. Estimations have to be made in an adequate manner which increases earning capacity of enterprise. 2. Determination of capital composition. Once the estimation has been made, the capital structure have to be decided. This involves short-term and long-term debt equity analysis. This will depend upon the proportion of equity capital a company is possessing and additional funds which have to be raised from outside parties. 3. Choice of sources of funds. For additional funds to be procured, a company has many choices like: A. Issue of shares and debentures. B. Loans to be taken from banks and financial institutions. C. Disposal of surplus. The net profits decision has to be made by the finance manager. This can be done in two ways. A. Dividend declaration. It includes identifying the rate of dividends and other benefits like bonus. B. Retained profits. The volume has to be decided which will depend upon expansion, innovation, diversification plans of the company. 6. Management of cash, Finance manager has to make decisions with regards to cash management. Cash is required for many purposes like payment of wages and salaries, payment of electricity and water bills, payment to creditors, meeting current liabilities, maintenance of enough stock, purchase of raw materials, etc. 7. Financial controls. The finance manager has not only to plan, procure and utilize the funds, but he also has to. Financial manager, particularly in business, is changing in response to technological advances that have significantly reduced the amount of time it takes to produce financial reports. Financial managers' main responsibility used to be monitoring a company's finances, but they now do more data analysis and advise senior managers on ideas to maximize profits. They often work on teams, acting as business advisors to top executives. Financial managers also do tasks that are specific to their organization or industry. For example, government financial managers must be experts on government appropriations and budgeting processes, and healthcare financial managers must know about issues in healthcare. Maximization. The objective of financial management is profit maximization. It cannot be the sole objective of a company, as there is a direct relationship between risk and profit. If profit maximization is the only goal, then risk factor is ignored. Sometimes, higher the risk, higher is the possibility of profits. Hence, risk has to be balanced with the objective of profit maximization. In addition, a firm has to take into account the social considerations and normal obligations to the interests of workers, consumers, society, government, as well as ethical trade practices. However, as profit maximization ignores risk and uncertainty and timing of returns, a firm can solely depend on the objective. Wealth maximization. Hence, the objective of a firm is to maximize its wealth and the value of its shares. According to Van Home, value is represented by the market price of the company's common stock. The market price of a firm's stock takes into account present and prospective future earnings per share, EPS, the timing and risk of these earnings, the dividend policy of the firm, and many other factors that bear upon the market price of the stock. The concept of wealth maximization versus wealth maximization. Total profits are not as important as earnings per share. Even maximization of earnings per share is not enough because it does not specify the timing or duration of expected returns. Further, it does not consider the risk of uncertainty of the future earnings. Hence, wealth maximization is appropriate, and it is possible by maximizing the market price per share. According to Professor Ezra Solomon, wealth maximization also maximizes the achievement of other objectives. Maximization of wealth of the firm implies maximization of value of owners' share capital reflected in the market price of shares. Therefore, the operative objective of financial management implies maximization of market price of shares.